The Case-Shiller Index just came out. Guys, the last year of losses are now gone. 1 year over year basis, the home prices are up 0.1%. Shout out to Cleveland. They keep saying that Chicago had the number one. Cleveland and Chicago had a 4% increase year over year, followed by New York. So Cleveland coming in strong again. 5th or 6th month in a row of gains. Now, the question is, why is the market down so much? Well, I was reading something that said, oh, the fear about the debt levels and all that stuff. No, it's not about the shutdown of the government. I believe, which there's 1,000 reasons why markets go up and down on a daily basis, but I believe that this is an indication for the Fed that things are still high. Inflation's still high. Housing is a big component. I think it counts for about 40% of CPI. It's amazing, guys. Literally 2 years ago, my fiance bought a house at 2.625% interest locked for 30 years. That same mortgage today is every bit of 7%. And yet home prices are still up. Why? 2 reasons. 1, inflation. When labor costs and material costs are higher, it just costs more to build stuff. But 2, and the big one here is supply of homes. 10 years ago, there were 4 million homes for sale in the market. Today, it's about 1 million homes for sale. When there's less supply, even a decrease in demand will still lead to higher prices. And that's what I always talk about when I talk about real estate. When people say to me, oh, you should buy in this city because it's growing. Well, it's growing, but they're also building a ton. So even if demand is up 100%, but supply is up 100%, you've had no change, essentially. But in this situation overall, we've had, demand probably has definitely dropped, but supply has dropped a huge amount. And that's the big key. That's the big difference. And I tell people, listen, I just engaged on Twitter. And by the way, if you want to follow me on Twitter because I'm very active there. I love discussing different economic topics. So follow me at Paul Gabriel. It's actually pronounced Gabriel, but spelled Gabriel. Say hi to me. But I talk to people and say, listen, there was a guy who made a great comment yesterday. He said, listen, if you're going to sell your home, think about it twice. If your rate is below 4 or 5%, think about it again. And I sat there and said, this is the decision that a lot of people are going to be faced with in the next few years. Because I truly believe the only time people are going to move now is because they have to, whether it's for a job, moving cities for a job, or family grew. And now, granted, if your income goes up, and let's say your income doubled from last year or 2 years ago, yeah, you can afford the doubling of interest rates very easily. But how many people have had their income double in the last 2 years? Probably very few. So when you look at home prices and at what's going on here, this Case-Shiller has boggled my mind. I would have never guessed 2 years ago that we'd see interest rates go from below 3% to above 7%, and then we would sit there and say home prices are still up. We are up year over year 0.1% from last July to this July. 0.1% increase. We've had 5 or 6 months in a row of gains. We have eliminated all. I just look at it saying, wow. And this is why inflation is the friend of real estate. Inflation has helped the situation. Supply has helped a ton more probably, but inflation has definitely helped. I'm remodeling a house right now, and literally I bought it in July of last year, 2022. It was mid-renovation. I bought it with just studs. The guy had gutted it before me, and then he decided to get arrested, so he lost the house to the government, so I bought it from the government. But either way, I remember doing a budget with my fiance and let's say, like, you know what, things are probably more expensive. Let me put more buffer in. And pretty much all those costs were way higher than I expected still. And I was just like, wow, how did this happen? But that's the way it works. And that's why over long periods of time, when you buy a home, as long as there's steady inflation and incomes stay up with it, you're going to see gains in your real estate values. Now, the other thing is this. I always talk about 1975. Let's go to 1975 to 1984. Now, for those of you who need a little history lesson here, this time was high inflation. Unemployment hit 10.5% in this time. We had high inflation though, and we had interest rates hitting 15% plus. But guess what? In 1975, the average 30-year was 9%. 1984, 13.5%. So exactly a 50% increase. But guess what? The average home was $32,000 in 1975, and I believe it was $81,600 in 1984. So you saw a 50% increase in interest rates. and you almost saw a tripling of home prices. Why? Inflation. Inflation came in here and said, hey, go look at average rents from that time. Skyrocketed. Go look at average incomes. Jumped up like crazy. Now, is it real growth, which means factoring in inflation? I haven't looked at that number. Probably over long periods of time, there's definitely real growth. But I look at this saying, how is this happening? It's exactly what I explained before. And the other thing, and I want to give a shout out to Cleveland, because people always take a dump on Cleveland. And I love living in Northeast Ohio. And I'll tell you, it's funny to me that we've had several months of why, because this is the way our city is. This is Lake Erie. This is a lake. How much more can you build? You can't go north. It's only in the suburbs. And how far are people really going to go out? That's the other thing when I tell people. We have, if you look at actually Schiller's book, Irrational Exuberance, when he talks about real estate, he says Milwaukee and Cleveland have the two most consistent real estate value increases. Why? Because there's not an oversupply of homes going. There's also the issue for us about land. Half of us, if we go north, we're in water, and we aren't going to go further away. So I look at these things. You have to remember that about real estate. These are the things I talk about. Real estate just isn't about where's everybody moving. I look at a city like New York. New York, I love that because confined land and the only place to go is up, and it's very difficult to go up. That makes it harder to increase supply. That's what I like. But look at cities like Dallas, Atlanta, Vegas. Just go out further. I mean, look how many cities have popped up around Atlanta and Dallas. Huge cities that have sub-cities within them. You know, when you say you live in Dallas, you might live in Frisco or Plano, and you have your own community there, and you're never going to Dallas itself, or you rarely go there. Atlanta, same thing. You live in Buckhead, you live in Lawrenceville, you live in some other suburb of Atlanta. That's your own little city. You don't actually go to Atlanta. So that's what I mean. And, you know, I want everybody to understand there's more to every sort of investment than just, oh, we like this, so therefore it's going to go up. And it's the same thing about real estate. I said to everybody a year and a half ago that I wasn't thoroughly convinced home prices were going to fall. And I'm not trying to take credit for that because I didn't think it was going to do this well. I didn't think we were going to have a crash. That was my point. It was say, hey, listen, if inflation's high enough, we're going to, and was I right on inflation? Sure, but inflation actually came back down very quickly also. I wasn't right about supply. I would have never guessed that the supply would be this bad. I mean, a 75% drop from 10 years ago. Over 4 million units to around 1 million units today. That's a big drop. All right, guys, so in this report, here are the 20 cities and their change from last year. Like I said, so Chicago was 4.4, Cleveland was 4, New York was 3.8, Las Vegas, a minus 7%, Phoenix, minus 6.6, San Francisco, minus 6.2, Seattle, minus 5.5. The hottest markets got hurt the most. Chicago's another city like New York where how are you really going further out? I mean, part of it's in the water, you know, you have to go into Lake Michigan, so you have to go up. If you go to the suburbs, you're too far from the city. I look at these things saying, oh, guys, I love you guys, all our California reps, but I'm not going to lie to you. I love seeing San Francisco fall. San Francisco. Listen, I look at California. There's a lot of problems in California. Costs too much to live there. Taxes are high and getting worse. In fact, I just saw the other day that Gavin Newsom is now proposing a tax that if you start a company but then leave California and you sell within 10 years, they want the taxes on those capital gains because you sold it. He's like, you can't start a company in California basically and make money off our labor and then move it to avoid the tax, which I get that. But hey, Gavin, here's another idea. Be tax friendly. Don't tax everybody who makes over $1 million a year 13.5% to 16%. Don't charge 5% fee on every house over $5 million when your cost of living is so high. When you have a homelessness problem in San Francisco, like guys, Nordstrom pulled out of their flagship store. I mean, there are issues there. Now, are we picking on certain areas? Of course. They're saying you could put a picture of Cleveland and it would look like Sarajevo in the 90s. But the whole point is, at some point, guys, people are going to say this costs too much. And yeah, the weather is awesome, but I can go. And for those of you who love that Californians are moving to Vegas and Dallas and Austin, the problem is just going to follow you eventually. It's just going to happen. It's going to be kicking the can down the road there. You know, and I'm actually surprised to see Vegas fall this much. 7.2%. So, you know, Tim just asked, how does this problem get fixed? I believe in free markets. Tim believes in free markets. I just think at the end of the day, these problems have to get fixed with supply and people get used to the interest rates. That's it. Like, so for example, my rate right now in my home is 4.25%. I locked it in a year ago with a deal with my bank to lock in 4.25. A year ago, that was okay. Now I have people going, damn, you got 4.25%. Look at you. People got used to higher rates. So 4.25 is awesome. My brother just bought a new house a month and a half ago. He got 5.5%, 6%, and he's ecstatic about it. That's the differences, guys. It's just people get used to things. As incomes go up, then all of a sudden you'll say, okay, it's 7%. And guys, guess what? That's about where rates should be. You know, it's not like we're at rates that are insanely high. It's not like it's the early 80s with rates being 15%. Rates for a home being 6 to 7% sounds about right. And the great news is I was adamantly against paying down extra mortgage when your rate's 3%. But now if your rate's 7%, that's a guaranteed 7% you get by paying down your mortgage faster. So if you have extra cash sitting around, your mortgage rate's 7%, pay that down. Guaranteed 7% return. The 10-year treasury is 4.5%. Would you rather make 7%? Every single time you pay down a debt, you get the rate, you're getting yourself the return of the rate you're paying down. So if your rate's 7%, pay that thing down. Now, the 10-year treasury is 4.5. The 90-day treasury is 5.4%. So if my mortgage rate's 4.25%, okay, and I can put my money at 5.4, why would I ever pay down my mortgage any extra than I have to? I wouldn't. But if my rate was 7.5% and I have extra cash laying around, I'll absolutely pay that because I'm going to get 5.4 in a 90-day treasury. That's the point of how you think about money. And for those of you Dave Ramsey followers, and he preaches till he's blue in the face, you should pay down your mortgage as fast as possible. Spoiler alert, he is wrong. But when you can get a 7% return by paying down your 7% mortgage guaranteed, I absolutely agree with that. If you have extra cash laying around, pay down your mortgage. You're giving yourself a 7% return. No biggie. So guys, follow me on Twitter. Say hi at Paul Gabriel. I appreciate your time. And remember, these things are all part of a cycle. We're not here to say what's good or bad. We're just here to say this is what this means for the future. Thanks very much.